Principles of Accounting, Chapter 26. In Chapter 26, we cover capital investment decisions or capital budgeting. So what capital budgeting or investment decisions looks at is extremely large expenditures. We're buying new plant assets, we're purchasing a new building, we're developing a new product line, etc. These decisions commit financial resources for long periods of time. And usually once we've started, it's impossible or very difficult to reverse that decision. We usually tie up money for several years. And so we need to make sure that we're making really good decisions. It's the process of evaluating and prioritizing our capital investment opportunities. Many entities do this for several years in advance, plan their capital budgeting expenditures, plan when they need to have money available, and so that's all built into their entire budgeting. Unlike the operation budget, where we're looking at a month to month or a year to year, because capital budgeting projects can take anywhere from like 1 to 10 years to pay for, we have to really think about what we're getting ourselves involved in when we're making that decision. So here are some examples of what an investment proposal might look like and some of those non-financial considerations that we have to look at. So we have pollution control systems. There can be environmental concerns. We might have a corporate image to protect. Factory lighting could cause better working conditions. It could improve product quality and efficiency because it's easier to see. If we have an employee health club or some kind of health, we pay for an employee health club as an incentive. We can have healthier employees, boost morale. But the same with employee childcare facility. It helps to enhance our attractiveness as an employer. When we're evaluating capital investment proposals, we're going to look at an example for an organization. So we have two investments being considered by a minor league baseball team. The first investment involves purchasing 10 vending machines for their stadium. The second investment involves the purchase of a new bus to replace the one they're currently using. They currently have no concession stand. The team's owner has received several bids for constructing a concession stand. The lowest bid is $150,000 and includes cash registers, deep fryers, a grill, soda machines, walk-in freezer, etc. Unfortunately, the team doesn't have that much money to invest. So they don't have $150,000, and that was the lowest bid that they had for a concession stand. So they're looking for different options. One of those options is vending machines. So the company is offered to sell the baseball team 10 vending machines for their $75,000 investment. The vending machine company is responsible for keeping them stocked, and at the end of a 5-year estimated life, Vendacorp will buy back the machines for a $500 each. So that would be the disposal cost. Vendacorp will also provide insurance and a maintenance contract that's going to cost an additional $3,000 per year. They can get revenues from the vending machines. So they've looked at, they play 45 games each season. They believe that the machines will generate $1,875 per game. So therefore their yearly revenue is expected to be about $84,375. Vendacorp receives 60% of the sales, and the baseball team gets to keep the rest. So we have this decision analysis here. We have an increase in annual revenue from the investment. Then our cost of goods sold, which is 60% of the sales paid to the vending company. Therefore, we have an increase of 40% in sales. We have that $3,000 insurance contract. We have 5 years of depreciation, and then we have an increase in utilities because they're vending machines. So therefore, our increase in pre-tax operating income, the additional income taxes we would have to pay. So our increase in annual net income from the investment is $10,000. Seems like a good idea when you think about it in that term. Well, we're going to raise income by $10,000, so we're working forward. So most information that we're looking at for capital budgeting, we're actually looking for the cash flows. So what is the actual cash receipts over the cash disbursements? So remember that cash flows and annual net income are not the same exact thing because the income contains non-cash items. So when we're looking at it, we would add back that annual depreciation expense to get our annual net cash flows from the investment because depreciation is a non-cash expense. Is that annual cash flow enough to justify the $75,000 payout? Well, that's where we use the different capital budgeting techniques to help us make that decision. The first one is called payback period. This is the length of time necessary to recover the entire cost of an investment. We take the amount to be invested divided by the estimated annual net cash flows. So if we have a $75,000 investment and annual net cash flows of $24,000, we have a payback period of 3.125 years. This only works if we have even annual net cash flows, this division. Otherwise, we have to look at the cash flows individually year by year. A short payback period is most desirable. So as soon as we have recouped the cost of the investment, then we are actually just making income on that investment. So you saw that the life of these is 5 years, and for the first 3 years, we're just going to be paying them off before we start making money on it. Payback period shouldn't be the only factor that we use for capital budgeting decisions, however, because it ignores profitability over the entire life of the asset, and it ignores the timing of future cash flows and ignores time value of money. We also have the return on average investment, or ROI. We looked at ROI a little bit in performance evaluation last week in chapter 25. When straight line depreciation is used, the carrying value of an asset decreases uniformly. So the average carrying value of the life of an asset is equal to the amount halfway between its original cost and its salvage value. If the salvage value is 0, then the average carrying value is simply 1/2 of the asset's original cost. So we see the average investment is the original cost plus the salvage value divided by 2. So we have these 10 new vending machines that cost $75,000. We have a $5,000 salvage cost. We take that and divide it by 2, then our average investment is $40,000. The ROI is estimated net income divided by our average investment. So for this project, the ROI is 25%. Does that mean it's a good project? Well, that depends on what our company determines is a required rate of return. So what is our cost of capital? What is our return available from other investment opportunities? And what is the reliability of our forecasts? So normally when we're computing ROI, like in chapter 25, we were using past information. In capital investing and capital budgeting decisions, we're using future or projected information. And we know that we don't have full control over what's going to be our actual information versus what our forecasts are. We just have to have this good faith that the forecasts are accurate and reliable. The weaknesses of the return on investment and the payback. The main weakness is that we don't consider the time value of money, which is the present value, which gives us the present value of the investment. It ignores the question of when we receive those cash receipts. Does it happen early or late? Do we have equal cash receipts? How long does it take us to pay back? What's the net present value of it? It also fails to consider the purchase price of the investment, which must be paid in advance. So if we have to pay that $75,000 today, but we're not going to recoup the money until later, the ROI does not take that into consideration.